Tonight we're going to have a look at the moving averages, and I really just want to familiarize you with them a little bit more, just to get your head around them, and just generally talk about what they are, how they work, because they're brilliant. Is of all the indicators that I use, that's the one I use most. So I do all my charting, I do all my marking out, but when I want to actually see what's going on right now, is I always look at the moving average. I look at the waves and the patterns in the moving average, and it literally is like a finger on the pulse all the time. So when I'm in a trade, I'm watching the moving averages. Is when I'm doing my chart analysis and all that, is I always check it off the moving averages. It's the one I would use most. If I'm sitting here looking at the charts, I'm looking at the moving averages. Is if I wasn't doing that, I'm not really sure what I'd be looking at. Actually, there's a question I thought to ask now. When you guys are like, because we sit here for hours and hours and hours, is what do you have in front of you normally when you're doing, like, just looking at the chart, looking at price action? What do you normally have on your screen?
I like to look at the RSI and the TDI.
Okay. Yeah. I have. Let me share my screen. I have the RSI at the bottom of my moving averages. It's actually one of the things I use with it all the time. It's brilliant. The TDI, I've seen people talk about that. I'm actually going to have to check that out, because I don't know what that one is. I don't know what the TDI is. What is the TDI?
I think it's a mix of the RSI and the Bollinger or something like that.
Okay.
It's a mixed indicator.
Okay. Similar to maybe the VWAP.
Yes and no. No, not really. Because it has some. It has the Bollingers, the RSI, and the moving averages.
Bollinger RSI. Okay, very good.
Yeah, it has some, like, there. I think I saw that on Traders Reality. They use them to see when the RSI drops out of the Bollinger Bands as a sign of volatility. So
okay.
it's considered a signal. So if you're trading the short time intervals for a double bottom or a double top, you would go in. You would use it as an entry or as an exit. Depending on which direction you're going.
Very good. Very good. So here's a, and then there's my RSI down the bottom. Yeah. I have this other chart. As well while we're here. I might put the TDI on it. Where is it? Oh, do you know? Sorry, I took it out. I did a bit of a clear out. My apologies. I have a chart that has the RSI, the trend wave is the stock RSI, and the MACD. Have those four indicators on one chart. Just looking at them, but I really found that the moving averages and the RSI and the Bollingers together are what I really look at to get my finger on the pulse of what's going on. Let me take that fib off the chart. But I wanna explain something that's really what makes the moving averages really valuable, is when you begin to recognize, like I said this before on another video, they're like waves. So you got like your small little surface wave, like your little splash and your foamy wave, and then you got your wave that makes the V shape, but that's within a wave that's maybe 2 or 3 feet deep, but then there's a current, and then in the ocean there's deeper currents, there's rivers in the ocean. So the moving averages are like that. So the five is like the surface of the water, where the 200 or the 800 will be the deeper currents in the water. Yeah, and very similarly to to the water is that a short snappy wave will come at you fast, and you'll feel the effects of it fast, and then it's gone. Where the bigger wave, the 200, say the 200 MA, is like a big wave where you feel the momentum of it coming off at a distance, and by the time it gets to you, it's over. But it's the momentum of the wave, and it's like one of those waves that when it comes in, it lifts your feet off the ground. One of those waves that lifts your feet up and you come back down again. A 200's like that, is you can feel it coming, but by the time it hits its peak, the force is already gone. So, and then there's the scale of that through all the different moving averages, yeah? So that's one element that I want to tease out, but also as well is the timelines. The timelines are really, really valuable. The timelines are really, really valuable when you recognize how they how they move with each other. Just checking on my price action over here. So when I click up here, you're going to see, here's all the minutes, here's the hours, here's the days, the weeks, and the months. Okay, so they work. There's like three groups of them that pretty much work together. Yeah, is you have anything from the 5 minute, which is like the tip of the spear. You know, it's whatever direction the price action is going. The 5 minute is the tip of the spear, or the 1 minute if you're scalping. Yeah. So you have the 5 minute, you have the 15 minute, you would have the hour, you would have the 4 hour, the 8 hour, and I'd say probably up to the 8 hour is you've got those body of times in one wave, if that makes sense. And then after that you have the 12 hour, the daily, and then all the days, 2 day, 3 day, all the way up to 6 days. You have those as another body of movement, and I'll go through it with you. Yeah? And then you have the weekly, and then the 2 weekly, the 3 weekly, the 4 weekly, and the monthly. So they all move. There's a synchronicity to them where there's like 3 separate groups, and when you get all 3 groups moving together, you get big volume. And this is why what's happening now, right now, in this chart here, is what's happening, you can even see it here. All the moving averages, this is on the 1 hour, all the moving averages, you can see how they're all beginning to bunch. And this is why price action is being held here. Because what it's doing is that it's drawing all the moving averages up to it. So when you look at price action, is earlier on today all the way up to I think it was the 12 hour, the 200 MA was below price action. So all the way in this bear trend, the moving averages were coming down heavy and strong. So all the way up to the 12 hour is now underneath price action. Excuse me. And they're all coming back up and gathering together. So they're coiling up. So that's the 200, the 144 weighted, the 100, the 50, the 20, the 10. They're all being drawn together. Yeah. However, that's on the short term. So that's on the hours. It's also on the days, but the weeklies and again, the weekly is going to pop soon, but there's all these moving averages in the next 4 hours, in the next day, aren't above price action. So you get what I mean that way, yeah? But what's above price action is when you go and you look at, I see the 1 day. Now you see the 1 day is you can see that these move, and this is the weighted 144 here. This is the 100 MA. This is the pi cycle 111. This is the 200 MA here. So on the daily, these are still coming down. You can see that they're still applying a pressure, yeah. Is in the 12-hour. Look, see in the 12-hour, look, they're all coming underneath. The only one that's above it is the 200. This is the new one I've been putting in. This is the 800 MA. So I'm only starting to put those in. So I know you guys use them, so I've been starting to bring them in. So, but when we go to the 2-day, you see now look what's above. So this is what I'm saying about all the shorter time frame. The MAs are all now under price action, but when you go on to the dailies, the MAs are above price action. So look, you can see the pressure that they're applying. So there's the 55 EMA, and you can see that that's holding the price there. Yeah. Same with the 3-day. I'll move this out of the way for now. So you can ask yourself, what's keeping price action where it is? Why isn't it pumping at the moment? Because on the dailies, the MAs on the dailies, look, some are starting to get underneath and scoop. So you can see there's the 20, the pink one, the 20 EMA, the 20 MA, the 10 MA here, the 5, and you see they're getting under and scooping. It was actually the 4-day. This is the 4-day. Is this 5 turning here pumped this candle? So this 5 turning pumped this. So you can see that there's ones getting underneath, but there's one still coming down. Like you can see on the 5-day, there's a pink 20 MA coming down right on price action. And I think this is the one that's holding it, the 6-day. The 6-day, this is the 20 and 55 EMA. This is the one that I think is actually holding it in place. So I think when this gets broken, it could be off to the races, so to speak, you know. So you can see that the hour, the 4-hour, the 8-hour in a time frame, they're all underneath, ready to go. Is the dailies, half of them are underneath and half of them are on top, you know, so they're positioning themselves. But all the earlier time frame, they're all now underneath and they're coming up and gathering in price action. So you can see they're all coiling up together for a breakout. So when you go to the week, now you can see the shift here. Look at the spread of the week. So here's the 100, this is the pi cycle 111. But look, it's almost like a scale, the 5, the 10, 55, the 20 EMA, the 20 MA, here's the 50 MA. So you can see the scale, and that's on the week. So you can see that that's lining itself up as well for the pump as well. But this could be a bit of a challenge. This 20 and 50 here could be a bit of a challenge to get past. So it would need a proper pump to break that, yeah. So on the 2-week, again, here's the medial line on the 2-week, and the 50 and the 20 here is this would be a challenge to get past. So you'd want to have all your ducks in a row, so to speak. If it's going for a proper breakout and we're heading to the bull trend, is you need to get past these, so it needs to be strong enough. So there needs to be enough of you need at least 2 of the groupings together to be in sync. So if you've got all the shorter time frames and you had the dailies all lined up ready to go, is you can have your breakout. Is if we're going for this big pump, as in this is going to be a new bull trend and we're breaking out of this year-long arc, is you'll want to have your weeklies, or enough of them, in with the dailies and in with the hourlies, to really break out. And that's what's happening at the moment. And that's also why things are getting dragged out. Everything is getting into position. And it's a really precarious time to actually trade, because there's it behaves differently now than it normally would, because it's being held. It's almost like the market makers are holding it in position. Like today we were looking at price action, and just there was normally the moving averages that were coming up to price action would pump the hell out of it. And it would pump it, and then it would just stop around 83, 83 and a half, and it just wouldn't go any further. And then those moving averages would get drawn in and closer to the other ones, and again they'd start rolling together. And again, that's the coiling up effect. So you can see that it's coming, you know. So now the 3 week. So again, the 3 week here is, look at the 5 coming down here. Although the 5 is turned, there you go, and that 3 week started on the 14th. So that's a really good sign that the 3 week is turned. Slowing it down is the 10 here, the 10 and the 20. And then the monthly. So you can see the monthly has the 5 and the 10 on it like that. So that's pretty strong on the monthly. To have them like that coming down is pretty strong. But now look, on the other side is you have the 20 here. This is the 20 EMA and 20 MA. So the 20s are ready to go up. The 5 and 10 are going not yet. So excuse me. So the battle there, you can see literally that's the push and pull of that. Yeah. So there needs to be enough in place to get that breakout. So that's really what the main thing I wanted to show you tonight is just this, that you can, as you're looking at your MAs, how to read them, and how to read the time frames, and how the time frames sort of work with regards how do they move. So they pretty much move in packs. You got the month, there's the weeklies up to say the first week. You got this one, and again you're looking at longer trends. Like you can see the trends here. Like you're looking at the longer trends here and what's happening. So if you see on the 3 week and you're getting down here like this, you know, as you put a fib on it and you're coming down, you go, okay, look, one of these is going to turn it. So what turned it is the 20 MA. But you could probably see that off in the distance. You see it coming down, you go, okay, it's either going to be the 10, the 20 EMA or the 20 MA that is going to catch this, stop it, so to speak. So you look around, well, what normally catches it? Well, it's the 20. So most likely this is going to get to the 20. So you could be weeks in advance looking at this going, okay, I can see where it's going. And you're mapping it out, but you got weeks notice. You got loads of notice, because again, the 3 week is letting you know what it is, you know. So now when it's coming down here, you know that it's going to get, like, this is where we are now. It gets into that choppy phase where it's turning and it wants to break up. So we're going, it's that transition phase. So we've been in that transition phase now for a bunch of weeks. It's dragging on, to be honest, you know, but it's very close to an end, and then the bulls take over, and we'll have a couple of months of the bulls. So always really valuable to be looking at these. I look at these every day. And it's not that things change every day, but I'm mind mapping it, and I'm keeping it in my mind, and I'm bookmarking it, you know, mentally bookmarking it, because these change. You know, every day the day changes. Every second day is the 2 day. Every third day. So you're looking at what's changing today, and how is the daily and the 3 day behaving. They changed today. How are they now behaving with each other? Is what way are they going to affect the trend? So it's a bull trend that's going up. Okay, today, the 1 day and the 3 day turn, are they supporting the bull trend? Are we looking for continuation? Or has one of them turned a little bit? Has one of them put a block in the road? And you can see that price action is going to have to deal with that. So you're starting to recognize what's going on over the weeks and months, but then equally what's going on over the week, and what parts of the week can you start to go, look, okay, this is the 3 days working for me now, but I think in 3 days time I can see that 5 is going to turn. I'm going to have a problem then. The 5 is going to turn. It's going to have an effect. So you're observing how your week is going as well, and then you have all your hourlies, and again how they're moving. So when the day turns, you're looking at your hourlies. The day turns, you see what the day does, and then I go through all my hourlies to see how they're all affected as well. And what I'm looking for is the pattern, and they're all moving in they're all moving in waveform. So you get used to looking at the waves and the pattern of them, and how they behave together. Yeah. So you're scanning that, so you can have a pretty good idea what your day is going to be like with regards to the price action. So, and then at 12 o'clock, when the 12-hour turns, is I'm always on that. I always like to be very present when the 12-hour turns, and the reason being is because you look at your day and it's like, okay, the day is up, and the first half of the day might be up, but the second half of the day, the 12-hour turns, is the 12 still up, or has the 12 turned? So you can get those days where all the pump happens in the early, and then the retrace happens later, and you're just checking to see the way the halfway through your day, what way the land lies. And again, as you go through the hours, the 2 hours, as they're changing, you're checking to see what way they're behaving, so to speak. Yeah. And it keeps your finger on the pulse of what's happening, and that's really one of the other points that I wanted to talk about tonight, is the difference between doing TA and projecting. So you're doing your TA to try and project a direction or project a target. Again, very important, and I do a lot of it all the time. Charting, I love charting, so I'm doing it all the time. Even I do it for pleasure, so it's great. However, is charting for projections is not the same as keeping your finger on the pulse of what's happening right now. Because the most important thing I think you need to do in all your TA is to keep your finger on the pulse, is to live it, is rather than taking snapshots, having a look, marking this, marking that, is you're sitting there and you're looking at price action, you're looking at your indicators, and you want your indicators to be alive in you, so to speak. So it's more important that you're able to read what's happening now and why it's happening now, than it is to do out a good TA chart about what's going to happen tomorrow or in an hour. Is because you need to know what's going on, and you need to know why it's happening. And the reason why is because that's where your trades come to you. Is you'll see your trade coming to you in your reading of price action. So as price action is moving and you can recognize it, you'll see your opportunity. So you can see, as an example, is with the TAs or with the moving averages, is you can see that in 4 hours time, that 4 hour 50, this here, I'll give you an example now, yeah, is this 50 MA here, yeah, on the 4 hour, this 50 MA here was coming up like this, okay? So now what happened is that it pumped this one, and you could see it was going to pump it, but then it spiked above this one and it created a pull down, okay? But then what happened is that the five came in, and there's a pull down here. Is the 5 come in here, and between the 50 and the 5, it pumped this one. So you could see you could see that that's going to happen. But now look where it is now. The 50 and the 5 are there. Remember I was saying to you about the wave? When the wave is coming closer to you, the bigger the moving average, the more force it has further away. So if you can imagine somebody standing 10 feet away from you and you can feel their presence, and as they walk closer to you, you can feel their presence more strongly. That's the bigger MAs. But by the time it gets to the wick or to the candle, its power is gone. Now the 5 would have more of an effect closer up, but the 50 a little less. 50 would be stronger a little bit further away. The 200 would be stronger a little bit further away. So why am I saying this? Is that they're now at the candle, okay? Is you can see now that this candle is retracing. So I suspect that, and again I'd have to look at other MAs as well, but I suspect that the next 4-hour candle, if it doesn't break out, because it's so on the tip and on the edge, will be a red one. And again, we'll get the 4-hour, if there's going to be another one, a 4-hour red candle coming down. Because of the position of these, because they're getting on top and then they'll become resistant. Even if price action is still up here, is their force is gone, they become resistance rather than support, and they'll start to pull it down. Okay, so, and then you can see the battle of, here's the 20 EMA and MA, and here's the 10 coming up here. These are going to put a bit of force on, but not on the next 4-hour, maybe the one after it. But now it's quite possible that if these guys turn and this turns red, candle comes down, pushes on these and pushes them a little bit more sideways. So if it pushes them a little bit more sideways, they lose their momentum. It's getting underneath like this is the direct effect. Is if they start going sideways, is they're less powerful because the force is going off that way. It allows price action to continue down. So it's quite possible that may be the story there. And the reason why I'm saying that is because I'm familiar with these type of movements and the way they can affect. And while I'm observing it, is I have a good idea of potentially what way it's going to go, simply because I've been watching it for so long. But I can see, my point is, well, what's happening now? This is getting a pump, and why is it happening? Okay, now no doubt there's other, okay, there's the 3-hour, and look, see the 10. See the 10 is after breaking the 50 here. See the 50 MA and the 10 is after breaking it strongly here. So now normally this would be a pump. This would be going. And look, there's the 5 underneath it. Normally this would be up, it's going, but you can see it's being held. You can see that it's been restricted for now. So this is the 3-hour. At 12 o'clock we'll see what happens. And we'll see whether this impulse here wants to actually complete its correction, or it's going to break out, because this is I'll show you now. It's a symmetrical triangle, and again it's a perfectly beautiful symmetrical. You couldn't get a nicer symmetrical triangle, and there a breakout to the top. So now the question is when the day turns, if it's going to last that long, is when the day turns, will the day give it a little push down before it goes up, or will it just pop it, or maybe push down a little more, give a little bit of a fake out, catch people, and then up it comes. Maybe we'll see what happens. So that's really one of the main points that I wanted to say to you today, is to begin to focus on, while you're doing your TA, is looking at having your finger on the pulse of what's happening and knowing why it's happening. If you make that the core of your engagement with your TA, all your charting then supports that. And then in that core focus is your trades come to you. And what you want to have is your trades come to you. So if you're just doing charting and you don't have your finger on the pulse, is what happens is that you'll do your charts, and then you'll wait to see if you're correct, and what happens is that we're looking to go in, and we can end up running after the entry point because we did the charting, but we're not actually following through with keeping our finger on the pulse. So think about whatever your indicators you're using, or your MAs that you're using, is get to a point where you can look at your indicators, and again you can see where price action is and why it's there and what's happening. That's really my main point today. It's more time consuming. That's one of the challenges with it. Is it takes up a lot more time because you're just observing in it, and part of your observing in it is you just want to see what's in front of you. So you got to put your bias to one side. Do you want it this way or that way? Well, it doesn't really matter. Is what is actually happening. So as a discipline of just reading what's happening, seeing it as it is, it's a very, very good thing to have in your trader's mindset, is to be just unbiased, looking at price action, and then looking at all the indicators or the moving averages, and just saying it as you see it. It's not about being right or wrong. It's just saying what you see. You get used to saying what you see. So a good example of that, and a good place to start, is this one. So this is the 55 EMA here and the 20 EMA. And then this is the VWAP. Okay? And if you're not used to looking at moving averages, it's good to break them down into their sections. So these guys dance very well together. So, and what I mean by that is when you're looking at them, but then you also want to get used to looking at them through the different timelines. So if we go into the 5 minute here, okay, I zoom in a little bit here. So you can see that it's had that spike out, and here it is again, pushing up again, and you can see that here's the retrace. Is what you're looking for is noticing what happens when they cross over. Okay, so noticing. Look here, when the 20 crosses over the VWAP, is you get a push down. Look, the 55 catches it. It runs along. There's a bounce here, and then up it comes. Look, the 20 broke the VWAP. What happens? You get a nice pump. Is you come here when the 20 breaks the 55. Look, you get a spill down. Now, this is on the 5 minute, but you're looking at that. You're looking at that all the way through them. And what I mean by that is, here's on the 1 minute. Yeah, is you can see that if price action get below this, and the 20 breaks the 55, you can see the spill. So you get used to reading those moments of transition. There's a divergence here. Price action is diverging from its peak, and now it's coming down, and here's why. So what's happening, and then why is it happening? The 20 is breaking the 55, okay, and there's the spill. So look, here's the bottom. The 20 turns and is coming up. So why is price action coming up? Because the 20 is turned and is pulling it up. Now why is price action continuing to go up? Because the 20 EMA is bouncing along. Okay, look, it spikes, it retraces back down. At some point you'll get this again. So you're looking at what's happening, and then why is it happening. But that's on the 1 minute. If we went to the 5 minute, I'll give you an example here. Is you can see it's peaking here, yeah? It drops a little bit, gets a spike through, okay? It's coming in closer. You can see that as this gets closer, if this breaks this, and it's looking like it's going to, is you're going to get this drop, okay? And then we got that drop. I think I might have posted this. I'm saying this looks like we're going to have a breakout now, a spill, because I could see the 5 is gonna cross over the 55. So I knew it was going to be more than this. This is the warning. This told me, this drop here, let me know that something bigger was coming. So then here we are here. Okay, and again, because all the moving averages are coming up, is rather than this having a breakout, it turns and then up it comes again, yeah. And it has this lift here, dropping down, and again, normally in the last previous Elliott waves in this arc, it's dropping down, but on this one, because it's the final one, it really is touch and go about, is it going to just go and break up now? You know, do like a micro ABC here and then just off to the races. Or does it want to do one more final push down? One more final push down, and again you can see the bottom here, push down and touch off the 80 cent or so, possibly even a fake out. You know, push a little bit more, just to catch people out. So now, I'm not going to keep going into this because you get the picture. But let's say you're just sitting there of a day, yeah. Is you can follow it down where you go. Look, there's the 5 minute doing the spill. If we go into the 10 minute, okay. So why did the spill continue? Because the 10 minute went with it. So look, here's the spill. Look, halfway through, the 10 crosses, well then you know it's for continuation. Okay, so because the 10 is crossing. Okay, if you go to the 15, ooh. Okay, what does that tell you? Is a spike down, and rather than continuation, the 20 turned, and I go, okay, now the 15 minute isn't up for continuation here. So then that stopped, turned around, and then up came. But if the 15 was coming down here, you go, oh, look, this is going to go for continuation. This is going to keep going, yeah. So, excuse me. So you get what I'm trying to say. Equally is, if we went to the hour, well, what's one of the things giving us a pump at the moment? Well, the hour is look at what happened here. The 20 turned, and again that crossed over through the VWAP, crossed through the 55, and look what we got. Big pump. Okay, and then as it's moving along, look, it drops to it here, catches it here, again here it is lifting it again, yeah. So what about the 4 hour? We went to the 4 hour. What was the 4 hour story? So 4 hour is further away. So now if you look at here, again this is a support line here, but look at how on the previous drop, how the 55 was the support line. So you can see, and you can support in here, you know, where look, the 20 is supporting here, the 20 is supporting here. Okay, and then look, it's playing in between it here on the 4 hour. So you can see how it's sort of the price action is dancing with it, yeah. If we go to the daily, so again, look how the 55 is support. Is when we get this breakout here on the day, is you're going to see this turn as well, and then you're going to get that big pump. So this 20 crossing over the 55 on the day is going to be a biggie, because look what happened. Look what happened when the 20 crossed over the 55 in the bear trend. Pow! That one there. That was a biggie. Comes down, look, double bottom, 20 turns up, catching it, bounces off it here, bounces off it here, and then look when it crosses, up it comes. And again, look, it bounces, you can see it coming down now, it crosses, going to be a big spill. So even if you were just trading like on the day, if you were trading like you you go in on trades where you trade the day and you'll stay in a trade for weeks. Is this alone is something that you could trade off, just using these two indicators. I don't recommend it. You should use more, but you get the point I'm making. Where if we go into the weekly, is when you go into the weekly, just tidy this up a little bit. So now here, look at the weekly. So you can see that one of the things holding the price down at the moment is the 55 and the 20 on the weekly. So on the hourly and the 4 hourly, it's support and the hour is pushing up, but on the weekly, and the weeklies are going, no, I think we need to wait a little bit. So you can see how, look at the bounce along. Look how price action bounces along the 20 EMA. And if the 20 EMA breaks, look, then the 55 catches it. Okay, here it is again. If it breaks, drops, comes up, the 55 is catching it. And then look, it drops again. And then here we are again. So we were looking at, oh, is it going to go down for a third one, do a triple bottom? And it doesn't look like it. It definitely looks like it's gonna pop. But why were we going, look, this looks like it's gonna go down again? Because there were so many moving averages were coming down strong still at this point. And the moving averages were clearly indicating that there was going to be more push down. Excuse me. And there was a few tries at turning it, and it failed. So it failed, and it didn't fail this time. And this is one of my lessons again from this one here. Yeah, is excuse me. I called this one beautifully, and I was calling it against the market. The majority of people weren't calling it. So I hit it beautifully. Then I called this one. People are going, no, I called it beautifully. I was going against the market. The majority weren't saying it. The problem with this one is people get used to things. They see it once, they see it twice, looks like it's going to happen a third time. Is this one here? Is the market decided, oh yeah, it's going to drop. So there was an awful lot of people shorting on this one where they weren't shorting on this one. So, and basically what I'm trying to say is that when I start to see too many people thinking it's going to go a particular way, I'm going to become far more cautious in my trading, because that's again what the market makers, that's what they want. They want everybody piling in here, and catching them out. And that's what they want. So all the people who thought that it was going to go down here, is this spike here, spiked them out, cut them all out. Does that make sense? So now there's this battle going on here, and this is very choppy. This is very choppy where it's looking like it's drawing the moving averages in. It's trying to draw people in, and you're getting people knocked out left, right, and center. So unless you've got a position lower, or you're going to use dollar costing and go in lightly, but then dollar cost down. So if it spikes, you're good to go. Is a very tricky time to trade, yeah. And I'll be honest with you, it could still go down. It could still go down. Why? Because it's in that flux at the moment, and this is where when something is in transition, when anything is in transition, it's more malleable. It can go this way or that way. So when price action is on the precipice here, and you can see there's a coiling of the MAs. There's still enough strong MAs at the top, putting a bit of pressure on. All you need to do is tip the scales a little bit, and you can push it down or you can push it up. And that's where That's where the market makers that's when they come in they're most effective. So yeah, so it definitely looks like it's going to pop, But then this is also the perfect time to pattern interrupt, and that's what happened here. Is everybody piled in here? Is what you do: spike them all out and pattern interrupt. So this is a perfect time to break the pattern, to tip the scales. So you can see how everything is getting into position here. That's why everything is moving really slow and price action is being held here. So that's you can hear I'm just trying to tell a little bit of a story. Is you think about as you're developing your trading, is you want to be able to read it as it is. Look at what's in front of you and just say it as it is. Get used to doing that. Is what's this candle doing? Well, it spiked through the 20, and this one broke through it. Okay, and did a retrace. Okay, this one had a proper spill. Like I'm saying the obvious, but that's actually my point. Is speak the obvious as it's happening. Get used to just speaking it as it is in an unbiased way, and that for the most part in your trading day, that's predominantly what you actually want to be doing. So when you're doing your charting, you still want to have that mind on. So you're doing channels, or you're doing lines, or you're doing fibs, whatever you're doing, is you still want to be able to just see it as it is, call it as it is, and then as you do that, results will appear, indications will appear to you. You don't need to go searching for them, they'll come to you. The more you just see it as it is and mark it out as it is as you're doing that, you'll start to see the pattern, you'll start to see the common denominators or the divergence, you'll start to see, oh, look at that, that's jumping out at you. And that's really what you want. You want your trades to come to you rather than you going searching for them. So they jump out at you. Is the things you notice, they're jumping out at you. They're coming to you rather than you, projecting or searching. Is you're just looking and seeing and letting it come to you. And it's a life skill. It's an excellent life skill. But when it comes to trading, it's invaluable. It's invaluable. And it's essential. So, and I suppose another element of that, just to talk about it, is it means you need to be centered. You need to be present. You need to have a clear mind. It's very difficult to do what I'm talking about if there's other things going on or there's distractions. So whatever your environment is it needs to be one where you can just sit down and focus on this and be clear, have a clear pathway time-wise, clear pathway energy-wise, and then a clear pathway mind-wise, that you can just look at things clearly. So that's part of no different than any other job or any other activity that you're doing where it requires focus and detail. Is you need to be focused and then focused on the detail. It's no different. So has anybody any questions while we're here?
Yeah, I have one. Do you prefer to use the EMAs or the SMAs?
Yeah, I use the 55, the 20, and the 55 EMA, and the EMAs are more immediate. And then I use the regular MAs, and then there's another one I use I have it here, because they're very good as a dance, as a tag team. The 5, is it here? No, where is it? Here it is. This blue line here is the 144 weighted, and then this one here is the 5 SMA. And very similar to what I was saying about the 20 and the 50, when they cross over, things happen. So what you're looking for is divergence. When they diverge over each other, things happen. So I use that one as well. So I'm happy to use a combination that work and work well. It's a bit like the Elliott waves, or the Elliott impulse waves and the ABCs. There's the Elliott wave theory. So you can get into the Elliott wave theory and really get into that. Or you can use the Elliott waves and the ABC corrections at your own discretion. You use them in a way that works for you. As long as they work for you, it doesn't matter. So if you're using these two indicators and you're able to see price action and it works for you, well then that works for you, and you're using them at your own discretion, and good for you. Is if you can have winning trades or successful trades on them, that's all that matters. So you got to think about, when it comes to the MAs or any of the indicators, you're using them at your own discretion, and you use them in the way that works best for you. And I personally like to use the impulse waves and the ABC corrections within the arcs, because it centers the options. You put an arc on, you put a triangulation on a price action on an hour, say. Well, within that triangle that's where price action, once you got the main impulse and correction coming in, the space that it's moving in for the next, what if it's a day one, for days, possibly a week. So I use the impulse and the correction within that space. That's it. And I use it very simply for that. And I only use it within that space. I don't look for it outside of that space or 20 other combinations. I put the fibs on it, and the fibs give me the up and down, and the impulses let me map it out. And I use that to follow price action as it's happening, and doing a bit of projecting on the charts. It all works very well together because of the combination in the way that I use it. If I didn't have the arcs, I wouldn't have a center in it. So then I start to look at all the other possible combinations of Elliott waves and what way they could go. And then what happens is that there's just way too many choices. And it's just like, well, which one is it? Well, I don't know. Once I set the chart, the arc, well, it's the one that's going to follow in there. So it simplifies everything. But it's not simple in what I mean is that it takes an awful lot of data, and then it takes out the data that's not relevant, and it just focuses on the part that is relevant. So the arcs is one of the most powerful things about the arcs, is that it's able to collate a lot of data into one very clear space, and it'll give you the wave motion within that. It's telling you that it's going to move in a wave in this. And when it comes to, you got the volume, then you got the consolidation, and then you got the breakout. Every time, the volume, the volatility, is then the gradual consolidation, and then the breakout. At the end of every arc, there's a breakout. So it's a set of impulses and corrections, and that's it. It's not 6 different choices, 6 possible ways it could go. No, it's only one. It's only one. And if you start to layer in the different timelines, so you look at a 15-minute, you look at a 1 hour and a 4 hour, if you're in the middle of a 4-hour arc and it's ascending, your next 15-minute arc is going to break up. Just as I'm generalizing. So then that your impulses, when they come to the end of that breakout, is going to impulse up. And that's where you get confluence. So now, that gives you confluence in a greater space, because you're looking on the 15, the hour, and the 4 hour. The space that price action is moving in. And you have it measured out, so that it simplifies the possibilities of what way things are going to go. Is it going to go up, or is it going to go down? Well, what does the hour tell you? The 4 hour? Well, they say it's going to go up. Okay, well then go with that. Mindful that it could go down, but if you really see what you see and you're looking at it, well, you go with the one where you go, this is going to go up. So that's where the combination of the arcs with all the other indicators is, when you have a center, no different than anything else in life. When you're centered, you're able to see from the center. So you see more. You see more clearly. You see in an integrated way. When you don't have a center, then you're looking at it from, because when you don't have a center, what happens is that things go into compartments. You have different compartments. So when I'm in a good mood, I'm looking at my TA from my good mood. But when I'm in a shit mood, I'm looking at my TA from a shit mood. And depending on how I feel, is that's going to interfere with my bias on the TA. But if I'm centered, is I'm always looking at it from the center. I'm always looking at it from a matter of fact. I may be in a good mood. I may be in a bad mood. But I still see the TA from my center and I see it clearly. So I can see through how I feel to get the clarity of the TA. How I feel doesn't affect my perception of the TA. That's what I'm trying to say. But that's because, again, maybe personally I'm centered. But now, what supports that in the TA is that you have something in your TA that you can center all your other indicators around and within. And that's what the arcs are. Is the repetitive pattern that keeps going on over and over and over on all the different timelines. You are centering yourself in that. Not just on the small timeline, but the medium and the bigger timeline. Every time you look, you're looking through that perception. And it keeps you centered. And it keeps you focused. And it gets rid of all the things outside of that. All the possibilities of what it might be and may be and this and that. They all fall by the wayside. And you look at what way can price action move in this arc once it sets itself. And then it's done an impulse. So the next impulse is going to be smaller. The next impulse is going to be smaller. The corrections are going to be smaller. Is now we're going to have a breakout. There's consolidation. Now we're going to have a breakout. Is it going up or down? Okay, well then check for confluence. Confluence says it's going down. Okay, well then it's going down. The market says it's going up. Don't worry about what the market says. Look at your TA, look at your confluence, and follow and trust your own center, your own perception. And that's really important. And I'll tell you why. Because the vast majority of traders don't have that. They don't get it. They're not aware of it. So it's having this indicator there and that indicator there and having them all, and it's all great, but they're not actually cohesive, and they're not looking from the one place within themselves or the one place within their TA. It's very easy to be swayed. It's very easy to be swayed when the person beside you says it's going up. Your YouTube influencer says it's going to pump today. You read the news, Jesus, XRP is going down tomorrow. You can be pushed and pulled 100 different ways. And how are you going to know that your TA is spot on? It has to come from yourself, and it has to come from a clear place. So while everybody else is being pushed and pulled and running around left and right, you're mindfully sitting there, doing your TA, minding your own business, getting on with looking at the thing that always tells the truth. Price action. It doesn't lie to you. It tells you what it's doing all the time, every time. It doesn't lie. Is it tricky to watch and follow sometimes? It is. But then that's the truth of it. It's tricky. But it's not telling you a lie. So you need to block out all that stuff, all those influences that are telling you it's this and it's telling you it's that. And you don't want to be giving yourself 20 possibilities, because now your mind is full of 20 possibilities that aren't real. They're not real. So what are they doing there? Well, they're filling my head up with stuff. Yeah, but is it actually any good to you? Is it any use to you? No, it's actually a distraction. So you want to refine, be cohesive, and give fine detail as you get more and more into it. That's really where you're looking to be. That means simplifying the complicated. Okay, this is the last thing I'm going to say. And listen to me when I say this, because it's true. A complicated mind, a person that thinks in a complicated way, who is that? A person who thinks in a complicated way is a person who has lots of compartments. And again, this is normal. It's not like a big secret, but I'm spelling it out very clearly. Is if a person is constant and consistent in one place in themselves, like their center, they become very straightforward and simple. But if a person has lots of different compartments in themselves, then there's always the trading and the mixing and the matching and the moving around. So when a complicated mind finds a problem, a complicated mind believes that the solution to the problem must be more complicated than the problem itself. So if I have a problem and I'm a complicated mind, I think that the solution, it has to be more complicated to fix the solution of this complicated mind. And then that complicated mind goes off looking for problems. And its interpretation is the problem must be big, so the solution must be even bigger. Nothing's ever enough. Nothing's ever enough. There must be more. There must be more. Where a simple mind, and what I mean by that is just a clear mind, a present mind, can look at a complicated problem, break it down into its parts, build it back up, put it together, look at the center of that thing and go, if you do this center line, if you hold the center here, this will bring everything together. Now, you've solved a complicated problem with a simple solution. And then I'll give you an example. Roy, what do you mean? One of the most important things that you can do in your trading is to be present when you're trading. To be here right now when you're trading all the time. Now that is not always easy, but it's simple. It's simply understood. You couldn't get any clearer about that. Well, what does that mean that I do when I trade? Well, when you look at the trades, you're just looking. You're not telling yourself you like it or dislike it. You're seeing it for what it is. If a candle goes up, it goes up. If it goes down, it goes down. It's that simple. You're just calling it as you see it. Left, right, up, down, whatever it is that simple. And that keeps your finger on the pulse, because the more you do that, is price action is going to jump out, the pattern's going to jump out, your trades are going to come to you simply by being present in them. And you're getting ahead of the pattern rather than chasing after it. That's so simple. And it's simplifying the complexities of trading. And I'm not saying it's easy, obviously, but the simplicity of it, this is the point I'm trying to make, is the simplicity of that is what is vitally important. Because it is a lot of information, there is a lot of data. So if you start going down the rabbit hole of trying to hold all that data and make it very complicated, you'll weigh yourself down with the complications of it. And I think everybody has to do that at the start, because there's just so much. And it's overwhelming at times. You're going to feel that. But as you develop, you're refining that, you're simplifying them. And what is it that you want from any indicator? You want it to work. You want to get a successful trade out of it. You don't need to be right about it. It doesn't matter. If you use that indicator, whatever way you use that indicator, if it works for you, good for you. That's it. You have found a simple way to be very effective with that indicator or series of indicators. That's all that matters. And everything else is just noise. So let it go. It doesn't matter. Just focus on what works for you. And then repeat it over and over and over. Be consistent. And then look for confluence. And when you have those two things, then you're a successful trader. It's back to the simplicity of it. If I have consistency and I have confluence, they're two of the main elements of a successful trader. Because you can be steady in what you're doing, and then you can check with all your different indicators to give you a cross-reference, a triangulation that pinpoints price action and its direction and where it's going to land. Triangulation. That's it. So everything else that you bring in coalesces around that, and you want to be cohesive in yourself in that. So it just takes time. It takes time. So guys, thanks very much. If you're not used to looking at the MA so much, pick a couple and just start looking at them. And I see pictures all the time. Do you see this one here? This is like a man to me. This is his back, his shoulders. Here's his arm. Here's his head. He might have a hat there or something. This looks like a cityscape. I see this all the time. Maybe it's because I haven't got to sleep very well for a couple of nights in TA. As I get delirious, so this looks like a man walking down the street to me. See all the chimney tops in here? Anyway, that's a side story. Okay, guys. Enjoy the rest of your day, the rest of your night, and I'll talk to you later.